The idea of putting money into artificial intelligence stocks has become one of the most exciting moves in today's market. Everyone hears about how AI is shaping the future, how it is changing industries, and how investors are making fortunes from it. But what really happens when a regular person takes just $100 and places it into AI stocks for a month? This is not a story of becoming rich overnight. This is a journey of discovery, about the market, about technology, and about the emotions tied to investing. When I decided to invest $100, I was curious. I wanted to see what would happen if I joined the wave of people pouring money into AI companies. $100 may not sound like much, but it is enough to test the waters, to watch the ups and downs, and to learn how powerful or risky this sector truly is. The beauty of modern trading platforms is that they allow anyone to buy fractional shares. That means even with a small capital, you can own a piece of a big company's. And with AI stocks being the most talked about, this experiment felt both exciting and a little intimidating. The first step was choosing where to put the money. Artificial intelligence is not just one company. It is an entire ecosystem. There are chip makers like NVIDIA, software giants like Microsoft and Google, startups exploring machine learning, and even companies building AI-powered robots. Each of them represents a different piece of the puzzle. After some research, I decided to spread the $100 across a few names instead of placing all of it into one. This was not just for diversification, but also to feel how different players in the AI race move in the market. Now here is where the story gets interesting. The moment the money went in, I started checking the prices every day. At first, it was thrilling. One day the portfolio was up $1, the next day it was down 70 cents. This might sound small, but when you are working with $100, every cent feels magnified. The psychology of investing hit me hard. I realized how easy it is for people to panic or get overly excited. Seeing green numbers gave me a rush, while red numbers made me question if I had made a mistake. During the first week, the AI stocks were buzzing with energy. News about breakthroughs, new products, and big contracts pushed some prices upward. NVIDIA's stock, for example, surged because of demand for AI chips. My small share grew a little, and that growth pulled the entire portfolio up. At the same time, another AI company dipped because analysts downgraded its outlook. This balance made me realize the importance of not putting everything into a single stock. Diversification, even on such a small scale, saved me from losing all progress. By the end of week 1, my $100 had become $104. $4 in a week might sound tiny, but think of it in percentage terms. That was a 4% gain in 7 days, something that traditional banks do not give in an entire year. This was the first lesson: growth can happen quickly in AI stocks, but so can losses. Week 2 was different. A sudden shift in the market reminded me that hype does not guarantee stability. One of the AI companies reported lower than expected earnings. The stock fell by nearly 6% in one day. My portfolio instantly dropped below my starting point. Suddenly, the $100 turned into $98. That sting was real. The emotional side of investing whispered that I should sell before it gets worse, but the logical side reminded me that 30 days is not forever and markets move like waves. I held on. The next few days showed why patience matters. Another major AI company announced a new partnership with a global cloud provider, and excitement surged back into the market. The portfolio rose again, not just recovering, but climbing beyond the earlier gains. By the middle of week 2, the $100 was worth $107. This roller coaster made me realize that AI stocks are not just financial instruments. They are tied to constant news cycles, innovations, and investor emotions. By week 3, something even more powerful happened. I stopped focusing only on the numbers and started reading the stories behind them. Why was NVIDIA climbing? Because businesses around the world are buying GPUs for AI models. Why was Microsoft moving steadily? Because of its integration of AI into everyday software like Word and Excel. Why did smaller companies bounce up and down? Because they are still in experimental stages where success is uncertain. This deeper understanding made me see the $100 not just as numbers but as a reflection of real-world progress in artificial intelligence. At the end of week 3, my portfolio stood at 111. That was an 11% gain in 3 weeks. At this point, I thought to myself, should I cash out now and lock in the profit? Many investors do exactly that when they see short-term gains. But I wanted to complete the full 30 days, no matter what. I knew things could swing in either direction. The final week was the most dramatic. A major news outlet published warnings about AI regulation. Governments were discussing rules on how AI should be used, raising fears that growth might slow down. Stocks reacted instantly. Prices dipped sharply, and my portfolio dropped back to 105. I felt the weight of uncertainty again. In just a few days, nearly half of my gains were gone. But then, toward the end of the week, another wave of optimism appeared. A different announcement about investment in AI research brought hope back into the sector. My portfolio climbed once again. On the 30th day, I checked my account. The $100 had grown into $112. $12 may not sound like a lot in absolute terms, but in percentage terms, it was a 12% gain in just 1 month. If that kind of growth continued every month, it would be astronomical. Of course, markets do not work in a straight line. Some months will be gains, some months will be losses. But this experiment revealed just how powerful and unpredictable AI stocks can be in the short term. The journey taught me several lessons. First, the importance of diversification. Even with only $100, spreading it across a few companies balanced out the risks. Second, the psychology of investing is as important as the numbers. Holding through the dips required discipline. Third, AI stocks move not just on financial results, but also on stories, news, and global sentiment. Understanding the narrative is as critical as watching the price. Looking back, the 12% gain was not just money, it was knowledge. If I had invested $1,000 instead of $100, that would have been $120 in profit. If I had invested $10,000, it would have been $1,200 in just 30 days. This shows the scaling power of returns, but at the same time, the losses could have been scaled too. If the market had gone the other way, I could have lost 12% instead of gaining it. So, what is the bigger takeaway? Investing in AI stocks is not a guaranteed road to riches, but it is a glimpse into how the future economy is being built. With just $100, I got a front row seat to the growth and volatility of a sector that is shaping everything from technology to healthcare. The experience reminded me that small investments are not about instant wealth. They are about learning, about building the habit of putting money to work, and about preparing for bigger decisions down the road. When people ask if $100 can make a difference, the answer is yes. It can grow, it can shrink, but most importantly, it can teach. In my 30-day experiment, it grew by 12%. That growth opened my eyes to the potential of AI, the risks of short-term trading, and the discipline required to invest. And while $12 may not change a life, the lessons behind it certainly can. This is where the real power lies. Anyone can start small. Anyone can test, learn, and experience the market. And anyone can use that first $100 as a foundation to build something much larger over time. AI stocks are exciting, unpredictable, and deeply connected to the world's future. By investing even in small amounts, you are not just betting on money, you are betting on progress.